Hello and welcome to Startup CFO Insights, your deep dive companion into the startup world's smart finance and data-based decision-making. I'm your host, Michael. Every episode, we explore the latest ideas and concepts on finance, fundraising, and business modeling. Whether it's optimizing your business model, mastering cash flow, or looking for funding, we've got you covered. Now, let's get started.
Okay, let's unpack this. We're going straight into the heart because the rules of engagement for fundraising, the expectations, the metrics, the sheer difficulty, they've structurally changed heading into 2026. This is not just some cyclical correction. It feels more like a re-anchoring of value. And it's driven by two massive forces: the pervasive dominance of AI and this aggressive return to profitability as the number one metric.
Absolutely. The era of, high velocity, low scrutiny fundraising is definitively over for the majority of the market. What we're seeing now is that volatility is being replaced by, extreme selectivity. Our mission in this deep dive is to give you, the listener, a clear roadmap. We're synthesizing the key data and forecasts. We've pulled insights from leading sources, KPMG, PitchBook, McKinsey, BCG, to track this transition. From the record highs of 2025, especially in those AI mega deals, to the precise strategic shifts you need to make if you want to successfully secure capital in this new demanding environment of 2026.
And we are not going to leave any stone unturned here. First, we'll look at the wild, kind of bifurcated landscape of 2025, which was dominated by just a handful of enormous deals, extreme capital concentration. Then we'll dive into the structural shifts forecast for 2026, including the emergence of a new, unexpected bottleneck that we're calling compute economics. And finally, we're getting intensely tactical. Specific, stage-by-stage strategies on exactly how to craft a winning pitch, how to customize your financial story, and secure your next round, whether you're a seed stage or, planning a pre-IPO push. So looking back at 2025, the picture is defined by one clear theme: concentration of capital. Unlike anything we've seen before, really, the market didn't just favor a sector. It felt like it funneled money almost exclusively into a handful of generative AI and machine learning giants.
That's the crucial observation. When we use the term mega round, we are talking about transactions that fundamentally skew the entire venture market. The data is staggering because it shows this clear market bifurcation. As of September 2025, AI and ML companies, they accounted for an astounding 64.3% of the total value of venture deals globally.
Wait, hold on. Over 2/3 of the total dollars invested went into AI. But here is the critical kicker. Those same AI companies only represented, 37.5% of the actual deal count?
Right. So that means for every dollar invested in the venture ecosystem, 64 cents went into AI. But those deals were highly, highly concentrated among a very small number of players.
Which basically tells the story of the haves and the have-nots.
It does. On one side, you have these category leaders operating with what amounts to a near-infinite capital runway. And they're effectively crowding out the competition. We saw this play out with two colossal examples that really defined the year.
Okay, let's talk about Databricks first. They're an established data analytics and AI platform, but their latest raise was, it was indicative of this new scale.
Precisely. Databricks raised a staggering $1 billion, and that pushed its post-money valuation to an eye-watering $100 billion. But crucially, this wasn't just a big round. It represented a 61.3% increase in valuation in less than a year.
Wow.
So investors aren't just betting on growth anymore, they're betting on dominance. They believe these AI giants will just consume entire sectors.
And then there's Anthropic. Their Series F round alone, $13 billion. That's
Right.
So large it rivals the total annual venture funding for some medium-sized countries. A $13 billion single round of funding.
It completely resets the expectations for what's possible in private markets. Their post-money valuation hit $183 billion. That's nearly triple their previous Series E valuation. When you see numbers like this, you realize that traditional risk assessment and, valuation metrics are almost irrelevant at this scale. These valuations, they reflect the market pricing in the potential for monopolistic or near monopolistic returns on foundational technology.
I think we need to pause here and just reflect on the psychological impact of these numbers on the rest of the ecosystem. If these giants are hoovering up all the capital, what does that actually mean for everyone else?
It creates enormous pressure. And this flows directly into what the sources call the unicorn effect. The data shows that these established, often late-stage companies, the unicorns, they dominated 56.8% of the total venture deal values.
Okay, so over half the money.
Yet they represented only 2.7% of the total deal count. So if you are a founder running say, a Series B in B2B SaaS, and you see that 97.3% of the deal activity is fighting over the remaining 43% of the money, your timeline just got a lot shorter, and your performance expectations just went through the roof.
So if you're not an AI native company or one of the top, 2.7% of unicorns, 2025 was incredibly tough.
Yeah.
But speaking of late stage, there was a necessary resurgence in exit activity, which is healthy for the overall environment, right?
It's essential. I mean, investors need liquidity to justify the massive funds they've raised and to deploy new capital. 2025 saw the IPO window, which had been, let's say, cautious, really open up, particularly in the U.S. and Asia.
Yeah.
The U.S. is sustaining a 4-year exit high, which means the markets are accepting new, large technology companies again. And Asia, too, is approaching a 3-year high.
And these high-value IPOs, they really underscore that optimism. We're not talking about small offerings. We're talking billion-dollar-plus listings.
Exactly. Figma, the collaborative design firm, had a massive IPO, raised $1.2 billion at a $68 billion valuation. Then you had Bullish, a digital asset exchange, which raised $1.1 billion. And we even saw international giants, like the Swedish fintech company, Klarna, successfully conduct a U.S.-based IPO, raising $1.3 billion at a $17 billion valuation. These are crucial signals that the mechanism for returning capital is functional, which, keeps the venture machine running.
So beyond pure AI, what other sectors managed to attract any substantial capital in this concentrated environment?
We saw significant flows into sectors that are either fundamental infrastructure or tied closely to geopolitical and national strategic interests. These include defense technology, essential hardware, and IT infrastructure. So things like data centers and semiconductors, quantum computing, and health technology. These are all really capital-intensive areas that either directly feed the AI compute boom or address long-term high-cost problems.
That makes a lot of sense. These are investments that require deep pockets and long horizons, often aligning with government spending.
And if we look regionally, we see some fascinating divergence. While the U.S. and parts of Asia focused on AI and supporting hardware, the source material indicates that Europe's primary focus for substantial investment was climate and energy tech. It just highlights that investment priorities are increasingly becoming national or even continental in scope, prioritizing resource security and sustainability alongside pure tech growth.
Now let's pivot back to the rest of the market, the early-stage startups outside of that AI sweet spot. If 64% of the money went into less than 40% of the deals, what was the experience like for everyone else?
It was a brutal screening process, to put it bluntly. For early-stage companies, think seed and Series A in traditional SaaS, e-commerce, or consumer tech investor scrutiny reached an almost unprecedented intensity. The primary shift was this universal demand for profitability and proven favorable unit economics. It was no longer enough to just show rapid user growth.
And we have hard data showing this tightening, right? Specifically impacting the smallest companies.
We do. PitchBook analysis showed a distinct drop in early-stage deal volume. The deal count for smaller rounds, so deals below $5 million, it fell from 57% of all deals in 2024 to approximately 50% in 2025. That seemingly small 7-point drop that reflects thousands of companies that simply could not clear the new, higher bar set by investors.
And why did that bar rise so steeply? Was it just fear, or was it a genuine philosophical shift?
I think it's a philosophical shift, and it's driven by the performance of the past few years. Investors learn the painful lesson that growth at any cost destroys value when the macroeconomic environment tightens. So for the early-stage market, you needed to be absolutely best in class. You had to demonstrate not just speed, but quality of growth. That means proving product market fit with low churn, excellent net dollar retention, and a clear, verifiable path to achieving operating leverage and eventually profitability. The expectation now is that a company has to be built to be robust, not reliant on endless external funding to subsidize a weak model. And that stringent focus is really the foundation upon which the 2026 forecast is built. So as we look ahead to 2026, we see this AI dominance, the capital concentration, and healthier exits persisting. But these trends are overlaid with some profound structural shifts that are creating new challenges and new opportunities for founders who understand them.
Okay, let's start with AI. We know the money will continue to flow, but you mentioned the nature of that investment is changing from application to foundation. What does that mean in practical terms for companies building software?
The change is fundamental. While AI mega rounds will continue for core model development, the real structural change is that AI is moving from being just another application that sits on top of existing infrastructure to becoming the underlying infrastructure that powers innovation itself.
So it's not a tool you use anymore. It's the core engine of your entire operation.
Exactly. McKinsey's analysis highlights this beautifully. They refer to AI as the common thread. It shows AI is already accelerating progress across robotics, bioengineering, energy systems. If your company is trying to solve complex problems in these fields, AI isn't an optional add-on anymore. It's the required high-octane fuel. For founders, this means investors will assess not just if you use AI, but how deeply it's integrated into your cost structure, your operational efficiencies, and your competitive moat. If you treat AI as just a superficial feature, you risk being dismissed entirely.
And this is where we hit the first major structural headwind for 2026. And it's one that connects technology directly to cash burn: compute economics. Why is the cost of running an AI model suddenly going to become a gating factor that could trip up even well-funded startups?
This is perhaps the most critical realization for 2026. The investment world is highly focused on IT infrastructure expansion data centers, GPUs, but analysts are anticipating a crucial slowdown. The major cloud providers, the hyperscalers, they are expected to actually reduce their rate of capital spending growth.
Why would they pull back if the demand for compute is just exploding?
Well, there are several reasons, all based on market maturity and financial discipline. First, they're facing shareholder pressure to transition from that CapEx-heavy expansion to operating profitability. Second, they are running into real-world constraints. Acquiring land, securing power grid capacity, and dealing with permitting delays have become incredibly complex and slow.
And what's the consequence of that reduced supply growth for a startup that's trying to scale a large language model or a complex robotics simulation?
It fundamentally alters their unit economics. Reduced infrastructure supply, coupled with explosive demand, that translates directly into rising operating costs for compute-heavy startups. Your cost per inference, or your cost per query, it skyrockets. This accelerates burn rates, and it dramatically erodes gross margins. A brilliant Gen AI company could suddenly find its business model untenable, not because of product failure, but because its core operational cost is simply unsustainable.
So investors in 2026 aren't just looking at marketing risk or technical debt. They are now assessing infrastructure risk, which includes factors like power supply and geopolitical supply chain stability.
That's the structural reality. The source material really emphasizes this linkage. This slowdown and the resulting cost increase, they tie into broader operational constraints in 2026. Power-constrained data centers, escalating energy costs driven by massive compute demands, and fragilities in the advanced semiconductor supply chain are now strategic risks. We're talking about specific, granular details, like the supply of advanced GPU packaging or high-density power delivery components becoming the difference between scaling and stalling. Investors are now asking, where exactly are your data centers located? Do you have guaranteed power capacity?
That's a level of diligence that moves into the realm of, what, utility planning, not traditional venture capital.
Precisely. And this new level of scrutiny, it feeds directly into the persistent challenge for early-stage companies: selectivity. The bar, which was already high in 2025, is only going to get higher.
So what should founders expect in the negotiation room as the selectivity intensifies?
They need to brace themselves for two key issues. First, investors will demand far more stringent, conservative growth assumptions. The days of forecasting 10x growth based on market momentum alone are gone. Second, this demand for rigor and caution means fundraising negotiations will take significantly longer. And because investors are deploying capital with more precision, the size of the eventual investment might be smaller than the founders initially projected or required. You might spend 6 months raising money only to get a smaller check than you aimed for.
That just sounds like a recipe for exhaustion.
Yeah.
And this environment also fully validates the shift in investor sentiment toward what's been called boring is the new bold.
It's the governing philosophy of 2026, at least outside of the AI stratosphere. Investors are actively turning away from high-risk speculative growth models that require endless subsidization. They're anchoring on business fundamentals. They value resilience, the verifiable quality of growth, and demonstrating mastery of the business model over sheer momentum or market hype.
And what does that quality growth look like in measurable terms?
It's all about sustainable unit economics. It means showing growth that's driven by high net dollar retention. So existing customers are expanding their spend and efficiency in customer acquisition. The source material confirms this sentiment shift globally. The BCG data point is very revealing here. A survey showed that European investors ranked long-term organic revenue growth as their #1 investment consideration, 46% of them. They want growth that is inherent to the product and the market demand, not growth manufactured through cheap capital and aggressive, unprofitable sales tactics.
So if rounds are shrinking and negotiations are taking longer, that puts immense pressure on a startup's financial runway. This forces alternative financing sources to become absolutely central to the strategy.
Alternative funding sources are now indispensable tools for survival, not just nice-to-haves. Startups must look beyond just traditional VCs. They need to proactively engage corporate VCs or CVCs, family offices, and strategic investors. These groups often have different mandates. CVCs seek strategic alignment. Family offices often prioritize long-term stability over a rapid exit, which could be a better fit for a company focused on quality growth.
Let's get specific on those tools. What are founders using to tactically extend that runway?
We are seeing a significant increase in the use of revenue financing, which provides capital based on predictable future revenue streams without taking equity. Venture debt is also highly strategic. It offers non-dilutive capital once a company reaches specific, repeatable revenue milestones, typically 2 to 5 million ARR. It acts as a bridge or a booster without the equity cost. Additionally, companies are maximizing non-dilutive sources like grants and the strategic use of R&D tax credits. These can provide a significant, predictable cash infusion back into the balance sheet. Using this smart mix of non-equity and strategic equity is how you buy the time necessary to meet the high bar of 2026.
So the market demands quality, resilience, operational mastery. Now let's move into the most critical section, the tactical plan. Given the increased scrutiny and complexity of 2026, founders can't use a one-size-fits-all pitch. So let's break down the specific strategies required for each stage. We'll start with Strategy A, seed pre-seed, and fast-growing SMEs with an initial product and some early revenue.
At this earliest stage, the challenge is proving viability in a market that's skeptical of everything outside of AI. The core focus must be on proving two things unequivocally: quality growth and demonstrable product-market fit. And that has to be validated by suitable unit economics. You're no longer judged purely on vision, you're judged on the initial foundation you've built.
So what does looking financially professional even mean at the seed stage in 2026?
Professional financial planning and control are absolutely essential. Investors will expect a detailed model that shows your assumptions clearly, particularly around customer acquisition costs and lifetime value. Your primary objective right now is stability. You must aim for a 12 to 18-month runway before you even start to fundraise again. Running out of cash in a slow market is, well, it's suicide.
Given how early they are, what's the best strategy for assembling the necessary capital?
The financing mix needs to be highly strategic and diverse. You start with angel syndicates and small specialist seed funds that focus on your specific vertical. Utilize accelerators, but most importantly, aggressively pursue non-dilutive grants and R&D tax credits if they're applicable in your region. For hardware or asset-heavy models, avoid dilutive equity at all costs. Instead, use leasing or pay-per-use structures to manage CapEx, or use revenue-based financing if you have early recurring revenue.
So when a seed stage founder walks into the room, what must the pitch deck pivot to? What are the imperative metrics they need to show?
They have to pivot away from high-level narratives and dive deep into business model-specific KPIs. You need to zero in on the CAC payback period, proving you recoup customer acquisition costs quickly, and meticulous retention cohort charts. Investors need to see that the customers you acquire today are better, more valuable than the customers you acquired 6 months ago. The pitch needs a crystal clear path to the next milestone, whether that's hitting 1 million in ARR, achieving an 80% gross margin, or reaching a specific net promoter score benchmark.
And the tactics for execution. How do you manage the process of actually closing the round?
Be disciplined about the process. Run a curated short investor target list, 8 to 12 potential investors, including at least 2 strategic or corporate VCs. Your data room has to be impeccable. It needs to include detailed unit economics, sensitivity analysis on your financial plan, and clear cap table scenarios showing dilution paths. And critically, you must secure 1 to 2 meaningful, validated pilot customers. In 2026, a pilot customer's willingness to pay and their testimonial about the product's value is often more valuable than a high vanity metric like total downloads. Okay, let's move to Strategy B. This is for Series A, early growth, or fast-growing SMEs that are already scaling revenue. The focus here shifts from proving fit to proving scalability and efficiency.
Right, the bar is much higher here. What's the core focus now?
The focus is proving you can scale repeatable revenue and expand your gross margin at the same time. Investors are looking for operational maturity. That means you must present detailed hiring plans for critical roles, sales, leadership, operations, and, reflecting the market, dedicated AI engineering talent that can embed that foundational AI layer we talked about.
What quantitative growth expectations should Series A founders be prepared for in this conservative market?
You have to demonstrate a credible, verified path to achieving 2 to 3x ARR growth over the next 18 to 24 months. And critically, this has to be coupled with continuous improvement in your unit economics. If you're growing rapidly but your margins are shrinking or your CAC is rising, investors will flag that as, growth dependency and they'll walk away.
How does the financing mix evolve at this, say, 2 to 5 million ARR stage?
You're now targeting dedicated growth VCs and strategic corporate investors. This is the sweet spot where venture debt becomes a highly strategic tool. Once you cross that 2 million ARR threshold with predictable revenue, you should utilize venture debt or alternative financing to fund growth without unnecessary dilution. However, given the longer negotiation times, founders must proactively plan for smaller rounds overall than they might have expected 3 years ago, and always prepare bridge financing options as an insurance policy, should due diligence drag on for 6 months or even longer.
And in the pitch room for Series A, what are the mandatory operational KPIs that investors are going to demand?
The conversation centers on retention and efficiency. Net dollar retention, or NDR, is paramount. It is the purest measure of product health and customer value. If your NDR is below 120% in B2B size, you have serious questions to answer. Churn rates, segmented by customer size, and detailed customer acquisition cost analysis, broken down by channel showing where your most profitable customers come from, are also required. But the real shift in 2026 is the financial requirement. You must present an integrated financial plan that includes a detailed 24-month cash plan. This is non-negotiable. A 24-month cash plan, so that means showing exactly how much cash you have, how much you burn, and when you hit zero under best case, base case, and worst case scenarios. That is deep transparency. It's the cost of entry for growth funding today. It shows financial control and preparedness. Furthermore, given the prolonged nature of these processes, companies must be proactive about maintaining employee morale and retaining key talent. Founders should proactively offer options for secondary liquidity for early employees and investors. It allows them a measured exit while the company continues its growth trajectory. This is a crucial, often overlooked, tactical move. Just prepare for due diligence to be the most intense and lengthy process you've ever faced.
That sets a very high bar for Series A. Okay, finally, strategy C, late stage, pre-IPO, or growth equity companies. These companies aren't proving the model, they're proving they're ready for the global stage.
The focus here is singularly on demonstrating a clear, credible, and accelerated path to profitability. The alternative is showing a sustainable revenue multiple that is so demonstrably greater than market comparables that investors are willing to pay that premium. Governance and external audit readiness are non-negotiable foundational requirements.
What happens if you're a late-stage company that is compute-heavy or focused on physical hardware? What unique financial data do you need to present?
Given the compute economics crisis we identified earlier, these companies face unique scrutiny. The pitch has to address capital expenditure scheduling in meticulous detail. Where exactly is the money going, and what is the guaranteed ROI? More importantly, crucial supply chain risk mitigation strategies must be front and center. Large, compute-heavy businesses must prove they have diversified their suppliers and secured power contracts to mitigate the operational bottlenecks of 2026.
And what does the financing mix look like for a multi-billion-dollar pre-IPO company?
The financing is institutional. You're talking large growth funds, crossover investors who manage both public and private mandates, and strategic anchor investors who often take larger stakes. The preparation is centered on the final exit mechanism, whether that's an IPO, a direct listing, or utilizing private secondary markets for large-scale liquidity. The tactics here are entirely about institutional precision. You must tighten your financials to the level of a publicly traded company. This means a detailed, integrated 3-year forecast, complete with rigorous sensitivity analysis showing outcomes under various geopolitical and economic stress scenarios. It is paramount to hire a CFO with direct experience managing IPO processes or large M&A transactions. And strategically, a staged secondary offering for existing backers is often used to satisfy liquidity demands while ensuring management retains core shareholder control through that crucial final scaling phase.
We've covered the tactical strategies, but success in 2026 clearly requires a deeper operational change. You mentioned that scaling now demands more than just engineering and design competency. What are the real-world constraints that founders must master that VCs are now actively scrutinizing?
The biggest structural challenge is this collision between massive technological ambition driven by AI and real-world infrastructure limits. The explosive demand for compute is fundamentally testing global capacity. This means founders must stop viewing labor shortages or permitting delays as mere annoyances and start treating them as existential strategic risks.
Can you give us some specific examples of these critical operational areas?
Think locally first. Labor shortages are severe, especially for highly specialized AI engineering talent. Then, we have the physical constraints, permitting delays for data center construction, local grid constraints on power supply, and escalating energy costs. And finally, the tightening regulatory frameworks, especially concerning AI safety, data privacy, and cross-border data transfer, are becoming huge strategic hurdles. If you can't navigate these, your business model is limited by external constraints, not by your product.
So investors are now asking, do you have a plan to secure power? Do you have a strategy to navigate local zoning laws to build the infrastructure you need?
Exactly. Scaling competency must now extend into three new critical domains. First, elite talent acquisition and retention in a fiercely competitive labor market. Second, proactive compliance management, ensuring your AI product can operate globally under tightening regulatory scrutiny. And third, strategic public sector engagement. You need founders who can talk to regulators and energy providers, not just product managers.
And here's where it gets really interesting, and where the philosophical difference between 2025 and 2026 becomes so clear. It's no longer about having an AI strategy, is it? That sounds like something you put in an appendix.
That is the fundamental mindset shift that separates future market leaders from those who will struggle to justify their valuation. AI is transitioning into an omnidirectional capability layer. It permeates every aspect of the organization. The question is no longer the simple tactical, what is our AI feature set?
So what is the new foundational question that founders must internalize and be able to defend to their investors?
The question has to be, how will AI rewire our entire operating model, our revenue engine, and our cost structure? This is an organizational design and financial question, not just a product question. It forces founders to think about how AI will reshape their infrastructure decisions, how it fundamentally changes their labor needs, and how it impacts long-term cost curves relative to competitors.
That makes AI the foundational substrate of competitive advantage, forcing a rethinking of the entire business.
That's the takeaway. It shapes product development, customer interaction models, infrastructure decisions, especially around compute architecture and supply chain resilience, and organizational design. Founders who embrace this holistic shift early, integrating AI at a deep, structural level, will be the ones who successfully raise capital on favorable terms. They'll demonstrate true operating leverage, and they'll build durable category leadership in the years to come. That ability to manage both the technological frontier and the physical constraints of the real world is the definition of success in 2026.
This deep dive has made it crystal clear that 2026 is a year that demands focus, discipline, and an acute awareness of external, non-tech constraints. If you are preparing to fundraise, let's quickly summarize the three most important points you need to carry forward from this conversation. We're synthesizing the data here from KPMG, PitchBook, McKinsey, and BCG.
The first crucial point is that AI dominance continues, but the focus is shifting dramatically. It's moving from being a mere application to becoming foundational infrastructure. This transition makes compute economics a vital new gating factor that dictates gross margins and burn rates. If you have a compute-heavy model, your infrastructure planning is, quite literally, your financial plan.
Secondly, investor sentiment, especially outside those massive concentrated AI deals, demands resilience and quality growth. The shift toward boring is the new bold is real. Clear unit economics, proven customer retention through high net dollar retention, and a transparent path to profitability are no longer optional. They are the non-negotiable fundamentals required to secure private capital.
And finally, successfully raising capital in 2026 requires customizing your approach by stage and aggressively extending your runway. This means utilizing alternative financing, such as venture debt or targeted grants, and focusing your pitch on stringent financial control. For growth stage companies, demonstrating a mandatory 24-month cash plan and detailed KPI reporting NDR, cohort retention, and CAC analysis by channel is essential to navigate longer due diligence processes and secure a favorable round.
And that brings us to our final provocative thought for you to chew on as you plan for the coming year. As national security and government-driven investment vehicles grow in importance, and as infrastructure limits tighten globally, how might the definition of a strategic investor change beyond traditional VCs? And what's surprising, non-tech constraints, specifically local grid capacity, regulatory frameworks for power usage, or regional energy costs, will ultimately dictate a company's maximum achievable valuation ceiling next year, regardless of how strong their AI model is.
Those real-world infrastructure constraints are the new competitive arena. We hope this deep dive provides the clarity you need to navigate that complex intersection in 2026.
And that was it. Today's episode of Startup CFO Insights. We hope you found our journey interesting. Further details about the topic can be found in the corresponding blog article at www.startup-cfo.services. If you like these insights delivered regularly, subscribe now and stay tuned. Have a question or a topic you want us to explore next? Get in touch with us at team@startup-cfo.services. Thanks for listening. Until next time, keep your runway long and your decisions driven by data.